What's going on, sagely investors? Welcome back to the channel. You know who it is. It's Crass back at you with another video. Guys, in this video, I'm going to go through 5 major points and concepts that you need to understand when investing in ETFs. And FYI, for your information, ETF, exchange traded fund, is exactly the same as an index fund. Why? Because an ETF typically tracks an index. It can track the ASX 300, it can track the ASX Real Estate Investment Trust Index, or it can track a international index. Okay, so point number 1, guys. Low fees should always be the main factor behind selecting an ETF, closely followed by the reputation of the ETF provider, whether they have a dividend reinvestment program, which is always a bonus, and finally, whether there are any tax benefits such as franking credits. Okay. Point number 2, think of the fee that you pay the ETF provider, such as beta shares, such as Vanguard. Think of that fee as the admission charge to getting into the diversification club. So the diversification club is the best club to be in. You don't want to be in the trading club. You don't want to be in the market timing club. You want to be diversified. Point number 3, understand that there is a very high price correlation across most ETFs, even between domestic and international. So there are actually no extra benefits to holding 12 or 15 different ETFs in your portfolio. You're just wasting your time and you're wasting commission fees on that. Ideally, you should hold between 1 and 5 ETFs at most. Reason being that there are ETFs that exist that capture the whole world. So you can buy a Vanguard Total World ETF and you have a little slice of every stock from every stock market in the world. That's easy. Or you can go for 3 different ETFs. You can buy a bond ETF, a stock market ETF, and a real estate ETF. So it really is up to you. Point number 4, when investing in ETFs, you will only ever beat the market if you have incredible luck and manage to accumulate more units at or near the troughs or the bottoms. So if you're super lucky and you manage to always buy at the dip and then at the dip and then so on and so forth, then you're going to effectively beat the market over that given period of time. However, as average Joes, as average investors, we're not going to be that lucky. No one is really that lucky. So on average, you're probably going to be 1 or maybe maximum 2 percentage points beneath the market return, okay? And finally, guys, point number 5. So if your portfolio is solely comprised of ETFs and no individual stocks, it means that you have finally realized that you have better things to do with your time than try and value companies, try and engage in risky trades, or even try and time the market, all of which are big wastes of time, okay? So why not take that time, enjoy life, smell the roses, start a business, start a side hustle, do something better with your time, learn a new skill, learn a new trade or something, okay? Play an instrument. But the time that you sink into trying to figure out whether a company is undervalued, whether a particular stock is going to be hot over the next 3 months, you're wasting your time, okay? Believe me, I've been there, I've tried that, I've learned my lesson. That's why I included that as point number 5. And guys, these 5 points are very important concepts that you need to understand around ETFs. That's whether you're a beginning investor or whether you are an experienced investor. So when you look at your overall portfolio, always look at it with the intent to try and simplify it, okay? We're here to make money consistently and as easily as possible with least hassle, okay? That's what it means to be a sagely investor. Okay, guys, if you have any questions, please put them down in the comments below. Don't forget to like the video and don't forget to subscribe and share this information. It's very valuable. See you guys in the next video.